Okay, I am George Dandridge Jr. I am the president of Dandridge Investment Group, senior tax consultant at Elite Eight Tax and Financial Services. I am also an enrolled agent. Um, I am part of the American Bar Association and a member of the National Association of Enrolled Agents. And of course, when you're doing anything virtual, you will have a last minute tech issue. So today we're going to be talking largely about the American Rescue Plan Act and the federal tax updates that just took place back on March 11th. And so some of those objectives are going to include talking about the federal tax due dates, payroll tax deferral, employee retention credit. We're going to spend a good bit of time on that one, as well as the sick and family leave credit. Then we're going to talk about some of the record keeping requirements, not just for just doing good business, but specifically for the PPP and EIDL programs. Briefly touch on the importance of tax planning. And then we're going to touch on a lot of the individual tax highlights. Those are a little bit more familiar than some of the business ones that we're going to be discussing today. We want you guys to keep in mind this information really is changing rapidly. It's based on our current understanding of the program. It can and it likely will change. We've had changes just as recently as this Tuesday as it relates to the unemployment part of this. So a lot of times there's a desire to be first to report information. Our quest is to be right. And so we try to make sure we have things on good authority using the IRS and similar things for a resource. But each one of you, your individual circumstances are going to vary. So we really encourage you to talk with your attorneys, your CPAs, your financial advisors. And we're going to ask that you hold your questions. You can put them in the chat, but outside of that, holding them until the end, because we're going to go through a lot of information fairly swiftly. So we're first going to discuss federal tax due dates. This is one of the first changes of the American Rescue Plan Act. It did not impact S corporations and partnerships. So for those returns, those are required to be filed or have an extension filed, a timely extension filed by March 15th. The penalty for missing that deadline is $205 per shareholder per month. So you really want to get with your tax practitioner quickly if you did not file that return and or that extension. Now, there are relief options available for S corps to remove those types of penalties, but that's outside of today's scope. But if you miss this deadline, again, get with your tax practitioner immediately. For C corporations, surprisingly, this date was not auto-extended by the American Rescue Plan Act. As such, you have until April 15th to file a return or a timely filed extension. The penalty for missing this deadline could be 5% of the unpaid tax for each month or part of the month that the return is late, up to a maximum of 25% of the unpaid tax. So again, if you're not going to have that filed in time, you really do want to get the extension filed so you don't have those unnecessary penalties. One of the, I guess we'll call it a rumor or misinformation that's out there is that nonprofits do not have a penalty for not filing or what have you. That is not the case. Those returns are due by May 17th. And if your fiscal year is different for those entities, then that changes to the 15th day of the 5th month following the end of the tax year. So if your tax year closes in February, then that return would be due, say, July 15th. In addition, an organization that fails to file the required return or electronic notice for 3 consecutive tax years, you automatically lose your tax exempt status. And then lastly, of course, for individual filers, the IRS has extended the filing date to May 17th. Now, what's important to note here is that normally if you file an extension, that is an extension of time to file, not an extension of time to pay. By the government actually making this extension, it also gives you an extended amount of time to pay. But if for some reason you don't see you getting your records and everything together by that time, we encourage you to go ahead and file an extension for that time. So there are some states that have been affected by winter storms, Texas, Oklahoma, and Louisiana in particular. Those dates have been extended until June 15th of 2021 to file their business and personal tax returns, as this event did occur prior to the original March 15th due date. Now, some other states may be impacted by other declared disasters. So again, this is something you want to check with your tax practitioner timely about to determine if your state, excuse me, or particular area will qualify. Quick note on estimated taxes. If you're self-employed, you probably pay taxes in four sums throughout the year. If you don't, you should. These are called estimated quarterly tax payments. The due date for these are April 15th, June 15th, September 15th, and then January 15th of the following year to get those in. And it helps you avoid a larger tax bill at the end of the year and kind of keep you ahead of things. So want to talk about something that kind of came up and then kind of went away, but want to make you aware of it if you did engage in it. We're going to talk about the payroll tax deferral. So the Consolidated Appropriations Act of 2021, this was signed on December 27, and it extended the period that the deferred taxes were withheld and able to be paid ratably. So it now goes to the end of 2021. Now, relatively few companies actually implemented the payroll deferral for their employees because there was no guarantee that the payroll taxes would ultimately be forgiven by Congress. Some may recall the deferral applied to employees who were paid less than $4,000 every 2 weeks, or an equivalent amount for other pay periods, which each pay period considered separately. So we commonly call it OASDI, Old Age Survivors and Disability Insurance. This is calculated at 6.2% of employees' wages. And Notice 2021-11 from the IRS makes changes to Notice 2020-65 to reflect this extended period. Now, payments that are made by January 3rd of 2022 will be considered timely because December 31st, 2021 is a legal holiday. So penalties and interest on those payments don't start until January 1st of 2022 on those unpaid balances. Let's go talk about the sick and family leave credit. If you offer this type of time, there were some key changes that you need to be made aware of. This is something I strongly suggest you work with your HR professional, whether that's in-house or externally, and your payroll provider to make sure you're covered on here. So changes under the American Rescue Plan apply to amounts with respect to calendar quarters beginning March 31st, 2021, basically yesterday. So we're starting today, the first quarter. A lot of the changes we're talking about kind of takes effect today, and then some that were changing or affected that goes to the end of June or July. It picks up from there and takes you to the end of the year. So it's easy to see how some of this information would overlap and cause confusion. So we want to remove some of the ambiguity here. So the Family First Corona Relief Act that was signed on December 31st, 2020, extended by the Consolidated Appropriations Act, made some changes to the paid and sick family leave credit. The American Rescue Plan enacted March 11 amended and extended the tax credits. And also it created the availability of advance payments on these tax credits. So we're going to talk a little bit about those. These provide sick and paid family leave credits that are increased by 6.2%, as well as you can also claim the employer's portion of healthcare expenses. It also increased the family leave dollar amount to $12,000, and it reset the number of days taken for sick and family leave as of yesterday. So increases for health plan expenses are included, and it also establishes a non-discrimination requirement. This is the part that you want to work with your HR professionals on. So the paid sick leave credit is designed to allow qualified businesses, those that have fewer than 500 employees, and who are paying a qualified sick leave wage to get a credit for those wages or compensation paid to employees who are unable to work, including telework, because of coronavirus quarantine or self-quarantine, or has coronavirus symptoms and seeking medical diagnosis. Um, in addition, the employer can receive the paid sick leave credit for employees who are unable to work due to caring for someone with coronavirus or a child, because the child school or place of care is closed, and that's a little bit of a change there. So sometimes in the past, under the uh, consolidation that you didn't qualify, now you do. So you want to take a good look at that and see if you can get those credits. Um, so the rescue plan also adds 3 additional qualifying reasons for the paid sick leave. If you're going to get the COVID vaccine, you qualify. If you're recovering from any illness or condition related to the vaccine. Also, if you're awaiting the results of a diagnosis or test, either if the employee has been exposed or if the employer is requested the test or diagnosis. Another major change is the rescues plan and elimination of the requirement that the first 2 weeks of emergency family and medical leave be unpaid. So now, if an employee qualifies for emergency family medical leave, they're eligible for a full 12 weeks of paid leave. This is assuming they have not previously used any EFML or other leave under the Family Care Act. And consistently, the revenue plan increases the total cap for EFML from $10,000 to $12,000. Another important change is the expansion of qualifying reasons to use EFML. And basically, now it can be used for any of the same qualifying reasons as paid sick leave. So this effectively means that if an employee qualifies for paid sick leave and needs leave beyond the 10-day entitlement for paid sick leave, the employee could take up to an additional 12 weeks of emergency family medical leave, assuming again that they have not previously used any of that time. So in practical terms, after today, April 1st, an employee could potentially take up to a total of 14 weeks of paid Family First Corona Relief Act leave. So let's talk about what's included in the qualified sick leave wages. In order to be considered qualified sick leave wages, they have to be subject to federal, state, or local quarantine and isolation orders, have been advised by a healthcare provider to self-quarantine due to concerns related to COVID-19, or experiencing symptoms of COVID-19 and seeking a medical diagnosis. Or you have to be caring for an individual who is subject to a federal, state, or local quarantine or isolation order, caring for a child if such an employee, if the school or place of child care for the child has been closed, including the closure of summer camps and enrichment programs. This is going to kind of come into play as the school year is closing down, and we've seen kind of some spikes in numbers. So when you start to have summer camps and different things that kids are going to, you have to keep an eye on this, as even yourself going back to work may qualify for some leave for that. Or they're experiencing some other substantially similar conditions specified by the Secretary of Health and Human Services. And what we did here was we put 2 links here to help you figure out how to qualify and how to determine the amount of the tax credit for both sick leave wages and for family leave wages. So next up, we have the employee retention credit. There's a lot of ambiguity around this credit, and many didn't take advantage of it in the past because of that uncertainty. So we want to give you some clarity on this underutilized credit by addressing some of the most common questions, such as what businesses are eligible, what's the significant decline in gross receipts, which employees can a business claim it for, what's defined as a small employer, the amount of wages that are eligible for the ERC, and how this credit is claimed and whether or not it's taxable. So the ERC was originally enacted under the CARES Act, the Corona Aid Relief and Economic Security Act. It later expanded and extended under the Consolidated Appropriations Act of 2020. So to understand changes to this credit made by the American Rescue Plan, it's easier to compare the ERC under each of these three laws, since each law deals primarily with only a specified time period. So the CARES Act, this credit was 50% of a qualified wage to employee plus the cost to provide healthcare benefits. Under the Consolidated Appropriations Act, which was became effective January 1st, it increased to 70% of qualified wages, including the cost for healthcare benefits. Under the American Rescue Plan, it retains that 70% credit, and it goes from July 1st, 2021 to December 31st, 2021, and includes that same benefit. Eligibility requirements for the credit. Under, this is the same as the Consolidated Appropriations Act. So under this election, the company can use its second quarter 2021 gross receipts compared to its second quarter 2019 gross receipts to determine the credit eligibility for the third quarter, and could use its third quarter 2021 gross receipts to determine credit eligibility for the fourth quarter of 2021. So just like the Consolidated Appropriations provision, this election is dependent on guidance that to be published by the IRS. So hopefully that guidance will be published soon. So the American Rescue Plan, or ARPA as we're calling it, this is a significant change. It allows for a recovery startup business to take credit subject to a maximum of $50,000 per quarter, even if none of the previous conditions apply to that business. So key points here, the recovery startup business, part of that credit is for businesses that began on or after February 15th, 2020. That business has no more than $1 million in average annual gross receipts over the prior 3 years. And of course, if you opened your business on February 15th of 2020 and you did $1 million that first year, great job. And then otherwise not eligible for the credit because the business wasn't shut down for COVID lockdown order or have a significant reduction in gross receipts compared to the same quarter in 2019, because that business would not have been in existence in 2019. So that credit continues to be capped at $7,000 per quarter for qualified wages between July 1st and December 31st. However, it adds a separate $50,000 per quarter maximum aggregate credit per quarter for the RSD, as we just discussed. The credit is was previously under the CARES Act capped at $5,000, so significant increase there. So whether or not the employee is working is been a question. There's a new category called the severely financially distressed employer, or SFDE. And SFDE is allowed to credit if its employees are performing services, even if it had more than 500 employees in 2019. So this would potentially apply to companies in several distressed industries, such as cruise lines or hospitality and entertainment venues. Because its effective date is July 1st of 2021, an SFDE will only be eligible to claim the credit for the second 2 quarters of 2021. This is not an income tax credit, it's basically a payroll tax credit. So how it's reported, typically if you have a third-party payroll provider, they would be handling this for you. So employers can access the ERC by computing their employee retention credit for a pay period and adjusting the required tax deposit downward by the credit amount. So prior to filing Form 941, employers that have an ERC in excess of the required deposit can request an advance by filling out Form 7200. This is the advanced tax credit form. A special provision in the CARES Act indicates that penalties for failure to make a deposit of employment taxes will be waived if the employer is determined to have a reasonable expectation that they're going to receive the employee retention credit. If eligibility for the ERC is determined after the quarter end, but prior to filing the 941, the credit can still be claimed on the form per the 941 instructions. And for those of you that are trying to handle this on your own, just a little bit of a tip, it's reported online 11C. Or 13D if applicable. The qualified wages exclude the health expense on that line, and that's reported on line 21. The eligible wages are still reported on line 5A for Social Security and 5C for Medicare wages. And then you're going to move the healthcare expenses over to line 22. The credit is definitely taxable. If the credit is claimed on 2020 payroll taxes, after the income tax return has been filed, an amended return may be required to accurately exclude the wages reduced for the employee retention credit. Now, if you're a pass-through entity such as sole proprietor with an LLC or an S corp, the owner's tax return will also need to be amended, as that will have some impact on there. This could also affect the 199A wages for the 20% qualified business income deduction. And the American Rescue Plan has a special 5-year statute of limitations that the IRS can assess deficiency for claiming the employee retention tax credit. So this is a very beneficial credit to use, but you want to be careful with it and how you use it. And we're going to talk a little bit later about using that in conjunction with the PPP, because there was some ambiguity there. Speaking of which, let's talk about the Payroll Protection Program. We're not going to spend a lot of time on the qualifications and things of that nature. What we really want to talk about is the forgiveness of the PPP and the tax implications of the PPP. So for federal income tax purposes, the loan forgiveness is not subject to income tax, and the expenses that are paid with the loans are deductible. And that was a very huge thing from last year, because it was an accounting question. But not all states that has an income tax follows the federal law on this. So something to be noted, the American Rescue Plan also expanded PPP eligibility for internet-only news publishers and additional tax-exempt groups and large nonprofits. So, and it also extended it past, it was originally supposed to end on yesterday. It has now been extended to May 31st, so you can still qualify for those funds. There were multiple PPP rounds. A lot of the terminology or qualifications for forgiveness on those are the same. So borrowers may be eligible for loan forgiveness if funds were used for eligible payroll costs, or the payments payments on business mortgage interest payments, rent, or utilities during the 8 or 24-week period after the disbursement of those funds. Now, to maximize loan forgiveness, you have to use at least 60% of the PPP loan proceeds for payroll costs. The second round, pretty much the same thing. You really want to focus on using 60% of the proceeds on payroll costs. And this is where the ERC part overlaps, because you can take a credit on the balance of those funds, or should I say the balance of those qualified wages, if in fact you only used 60% of your PPP funds for the payroll costs. When to apply? Loan forgiveness, you really want to work hand in hand with your PPP lender. A borrower can apply for forgiveness once the proceeds have been used or anytime up to the maturity date. You want to note that if you don't apply within 10 months after the last day of the covered period, then it can no longer be deferred and you'll start making PPP payments to the lender. So the how to apply, you're going to contact your PPP lender and complete the correct form. They can provide you with the SBA form 3508 or 3508 Easy or 3508S, or they may have a lender equivalent to this form. So that's why you have to go directly through your lender to see which forms they want to use. And then you're going to compile your documentation. For the payroll documentation, you want to make sure you include bank account statements or third-party payroll service provider reports documenting the amount of cash compensation paid to employees. You want to include your tax forms. This is going to include tax forms or the equivalent third-party payroll service provider reports for the period that overlap with the covered period for the alternative payroll covered period. Payroll tax filings, typically this is you're going to be your 941s. State quarterly business and individual employee wage reporting. State individual employee wage reporting and unemployment insurance tax filings reported or that will be reported to the relevant state should be included with that documentation. Also, you want to include employer contributions to employee health insurance and retirement plans, as that's also a deductible fee, and you can do that by providing payment receipts, cancel checks, or account statements documenting the amount of an employer contribution to the employee health plan. For non-payroll expenses, you want to include the business mortgage interest payments or rent and lease payments, and then any type of utility payments. Now, this list isn't a complete list for all lenders, so you do want to check with your lender again for the required documents. And then from there, you're just going to submit the forgiveness form and documentation to your lender and consult the lender for additional guidance and what documentation they're going to be requesting. And due to overwhelming demand, for some type of guidance on accounting for these loans, the American Institute of Certified Public Accountants, in consultation with the Financial Accounting Standards Board, issued guidance back in June 2020 in the form of what we call Technical Question and Answer 3200.18. And this was titled Borrow Accounting for a Forgivable Loan Received under the Small Business Administration Paycheck Protection Program. If you are doing your own accounting, you definitely want to take a look at that, because what we found in some early tax returns for the year is that the balance sheets and profit and loss statements didn't properly categorize these funds, and people were actually over-reporting income as a result and reducing their capital accounts. This one was kind of a silent one. You heard about it and then you didn't, mostly because there was the qualification of having previously applied for an emergency EIDL grant, and then there was the new criteria for the targeted EIDL. So the American Rescue Plan that was signed on March 11 includes $10 billion in additional funding for these types of grants, as well as another $5 billion to fund $5,000 supplemental grants for businesses with 10 or fewer employees that had suffered an economic impact loss of at least 50%. These grants were only really an extension of the emergency EIDL grants under the CARES Act that had some different requirements. So first, to qualify for the full $10,000 targeted EIDL, you had to be located in a low-income community. And the SBA has released an online tool to help borrowers understand if they're in a low-income area, but they noted that the business address has to be located in a low-income community in order to qualify. So the SBA encourages potential applicants to check the map to see if they're in the low-income eligibility requirement prior to applying. You also have to have suffered an economic loss greater than 30%. We're going to talk about how to gauge that. And then lastly, not have more than 300 employees. So for demonstrating your economic loss, It's defined as the amount by which the gross receipts of the covered entity declining during an 8-week period between March 2nd, 2020 and December 17th, 2021, relative to a comparable 8-week period immediately preceding March 2nd, 2020 or during 2019. Now, that might have thrown you for a loop when we were talking about how you can use the ERC or whatever, but this is specifically qualifying for this targeted EIDL. And the SBA is also going to develop a formula for seasonal businesses. However, those will be uh, considered for an EIDL advance grant at this time. So getting your tax documents organized and up to date obviously is going to be essential for applying for this grant. Um, we realize that there's been a lot of changes already to and throughout the tax season. But basically, if you have your P&Ls and balance sheets in order, you can kind of move through this pretty quickly. So if you have not previously applied for the EIDL, you may apply at SBA.gov and get that low interest rate as long as the funds are available. In addition, additional qualifications: has to be a small business with fewer than 500 employees, operate an individual that operates as a sole proprietorship with or without employees as an independent contractor, a private nonprofit, and business have been in operation by January 31st of 2020. And the business has to be directly affected by COVID-19. One section of the EIDL that a lot of people are unfamiliar with is the bookkeeping and record keeping requirements. And this outlines the responsibilities such as maintaining the books and whatnot for a period of 5 years. So some of the conditions of that EIDL loan is maintaining current and proper records for the most recent 5 years until 3 years after your loan maturity or after it's been paid in full. Some of these records include financial and operating statements, insurance policies, tax returns and related filings, such as your payroll taxes, records of earnings and dividends distributed, records of compensations to owners or shareholders. And these same requirements apply to the PPP as well into just doing good business. So you will have to allow the SBA to inspect or audit your books and records on demand. So you don't want to play catch up on that. You want to have those things in order constantly. And then they have to be allowed to inspect or appraise any business assets that were claimed. And then you'll have to provide them with a financial statement within 3 months of the end of the fiscal year. Looked like my screen got stuck there. So, big deal here about what information an eligible employer should receive from an employee to maintain or substantiate the eligibility for the sick leave or family leave credits. Obviously, there's the employee names and the dates and a statement of the COVID-19 and whatnot and why they weren't able to work. But there's a few other things you want to consider in the case of a leave request based on a quarantine order or self-quarantine advice. The statement from the employee should include the name of the government entity ordering the quarantine or the name of the healthcare professional advising self-quarantine. And if the person subject to quarantine or advised to self-quarantine is not the employee, then you want to have that same information for the person in which they are caring for. And this also applies to caring for a child in the event that the care provider is not available or the school is closed or something of that nature, even if that's one of those summer enrichment programs. So with respect to the employee's inability to work or telework because of the need to provide for care of a child older than 14 during daylight hours, you're going to need a special statement of circumstances requiring the employee to provide care for that. So even though PPP and EIDL expenses are deductible, um, by now I'm sure you guys have seen the clear and evident need for tax planning, as evidenced by the ERC, the sick and family leave credit, and the payroll deferral. So effective tax planning can reduce your tax liability in current, future, and even past years, both in business and personally. So there are many considerations that wouldn't otherwise be optimized in a regular tax preparation. So in the time we have left, we're going to examine some of the individual tax updates of the American Rescue Plan. How are we looking on time? Okay.
We have approximately about, I would say about 13 more minutes, George. So you're doing great.
Okay, great. So let's touch on the child tax credit. And for these, I'm going to kind of speed through these a little bit and touch on the high points. There are some changes on the child tax credit that only apply to tax year 2021. One part of that is it being refundable and not having to be on a joint return if the taxpayer is married. The qualifying child 17 or younger qualifies for the credit, 3,000 per qualifying child, 3,600 if the qualifying child is under age 5. This is not to be confused with the dependent care credit, which we're going to talk about in a moment. So the additional amounts are reduced by $50 for each $1,000 or fraction of by which the taxpayer's modified adjusted gross income exceed 150,000 for joint returns, 112,500 for head of household, and 75,000 for other filing statuses. 7527A provides for advance payments. This is something you guys may have heard of, and it's going to be a big deal for 2020 and have impact on your 2022. So you can get 50% of the anticipated 2021 child tax credit in equal periodic payments beginning in July of this year through December of this year. So that anticipated credit the taxpayer can elect out of advance payments using an online portal that the IRS has said it's going to create. The IRS will provide a notice of advance payments that will be made. And then the taxpayer will have to reconcile advance payments against the actual 2021 credit, and excess advance payments are repaid on the 21 tax return. So the children are going to be aged to their tax year in 2021, and amounts can be adjusted based on later filing if you have not yet filed your 2020 tax return or haven't done so by the time this advance credit becomes available. One thing to note is that the advance payments are not subject to offset for past due support, federal agency debts, state income tax debt, or unemployment compensation debt. So if you're entitled to that funding, you will be able to get those funds, and it's not assessed federal taxes subject to levy or collection. Let's talk about the earned income credit. This is another one that's going to be have some changes that are just for 2021. One of the changes under the current law, if the taxpayer has no qualifying children, they have to have attained age 25, but not age 65 by the end of that taxable year. So this is another big opportunity for advanced tax planning if you have a college student or student entering college. So they must have attained age 19. If they're a specified student, though, excuse me, let me get this order real quick. If they're a specified student, then age 24. Then there's this provision for former foster youth or qualified homeless youth. For them, they have to have attained age 18 and they can qualify for this credit. Now, where the tax planning part of this comes in at is a specified student that can get the American Opportunity Tax Credit is eligible for that at least 5 months out of the tax year. You have to really take a good look at whether or not they will be better suited filing their own return for the purpose of this earned income credit. So under the new EITC, under current law, you can only claim it if married, if you're filing a joint return. This is going to change, and my understanding is it's currently intended to be a permanent change where you don't have to file a joint tax return for the tax year, but you do have to reside with the child for more than half of the year and meet a couple of additional requirements. So under the Consolidated Appropriations Act for tax year 2020, if a taxpayer earned income less than 2019, it can use the earned income from 2019 as its earned income for 2020 to take a greater earned income credit. This one is very, very big. The dependent care credit that's changing. Number one, it's becoming refundable. In the past, the maximum credible expense was $3,000 for one qualifying child or $6,000 for more than one qualifying child. Under the American Rescue Plan, the credible, well, number one, it's going to be refundable, and two, it's going to be $8,000 for one qualifying child and $16,000 for more than one. Here you see some of the new credit rates. Prior, it was a 35% credit rate up to a $15,000 adjusted gross income, and then it reduced 1% for each additional $2,000 of AGI down to 20% of the credit rate for 43,000 or more. Now it's going to be 50% up to 125,000, and then that'll be reduced for, by 1% for each additional $2,000 of AGI up to 185,000. Finally, topping out at 20% for 400,000, and by the time we get to 440,000, you just won't get the credit at that point. Another big thing is if you had any type of retirement plan in 2020 that you took a distribution from, you want to, this is combination of tax planning and understanding what this law means for you, but you can qualify that distribution as a coronavirus related distribution. And as such, you have some choices. You can choose to spread that distribution over a period of 3 years from 2020 through 2022, which would basically reduce your tax liability and kind of make a very predictable AGI in those future years. You can also repay it over a period of 3 years. Now, this requires that provision for your plan administrator to participate in that provision, but if you do that and you pay it back, then obviously it has no tax implications or whatever. It also takes away the additional 10% penalty for those under age 59 and a half. So many people will qualify for the retirement distribution consideration, and I advise you to talk to your tax professionals about that. Some of the last considerations, the advanced premium tax credit, there's no additional tax liability on that. The unemployment and premium tax credit, you want to take a look at that for 2021 and how it impacts you. One big change for businesses is that excess business losses have become limited. The non-corporate taxpayers for 250,000 and 500,000 if you're married filing jointly. A lot of people will see this 1099-K form in this current year. Previously, it was if you had $20,000 in credit card sales. That has been changed, and the reason is basically due to the gig economy. We're seeing a lot of transactions ranging from Uber Eats to you name it. A lot of non-business entities are seeing these credit card transactions. So the new reporting is a payment settlement entity must report it if you have transactions exceeding $600. A very small amount and basically encapsulates everybody. So you will see a lot of those statements going out. And then one of the things I've seen this year, I mean, prior to 2020, it was very rare that a married person filing a separate return, a separate tax return, really made any financial sense. We are seeing this year, based on some of these different provisions for the first time, that you really have to do a married filing separate analysis to see which is going to benefit you better, especially if you're looking at different distributions from retirement and whatnot. So closing out, we wanted to make you guys a very special offer. If you go to elite8financial.com, and if you are seeking a tax professional and or do not have a tax professional, you can go to elite8financial.com/appointments, and we have a special code link there for you, USBC special offer, and it will give you half off your appointment consultation. And in that consultation, basically what we will do is do an assessment of your current tax situation, and then advise how we can help forward or how you can prepare questions for your tax practitioner. And you can reach us several ways. We're based here in McKinney, Texas. We have a vast virtual presence. So we have clients all across the state as we represent clients in tax matters all across the United States. So you can reach us on the website at elite8financial.com. You can follow us on LinkedIn at the Elite Tax Boss, or on Elite 8 Financial on Facebook, Elite 8 Tax on Twitter, and Elite 8 Tax Financial on Instagram. And we're going to turn it back over to you, Philip, for closing comments.
Wow, George, that was an amazing presentation. It was packed with a lot of very valuable information. And as you can imagine, we had some questions that came in, and wonder if you can hear me okay before I start asking some of these questions.
Yes, sir.
All right. So the first question, of course, everyone wants to know, will a copy of this presentation be provided after this webinar? And the answer to that is yes. George Dandridge and Elite 8, they were very gracious with providing us with this information. So I want to make sure that we make that available to all of our attendees 24 hours after this presentation. And I believe, George, that special discount will still apply in that package, right? You said that's good until May 1st, right?
Correct. That is good through May 1st.
All right, perfect. All right, we've got a couple of questions that came in from the audience, and we're going to ask George those questions here live. And then we have some information we're going to share on behalf of the United States Flag Chamber with all of you as well. So I'm going to try to keep you here for another couple of minutes just to get you some good, valuable information. George, the first question that came in, what is the penalty for missing the March 15, 2021 tax date? I'm guessing the extension had to be filed before that date.
So for S-corps and partnerships, that date was March 15th, unless you reside in Texas, Louisiana, or Oklahoma that were impacted by the storm. So if you missed that date, the penalty is $205 per shareholder per month.
Okay. So that's $205 per shareholder per month.
Yes, sir.
If you missed that date and you didn't reside in those states impacted by the winter storm.
Correct.
Thank you, sir. All right, our next question. How long is the targeted title process, EIDL process? Some of us were told that it's between 4 and 6 weeks, but sometimes it's taken longer. Some folks have heard just to wait on an email response. Is that information that you're privy to?
So my understanding, and I don't work closely with that particular program, but my understanding was that if you had done a previous application, that the SBA will actually reach out to you, that no further action was required. As far as the timelines on the process, I'm not really privy to that. I know that there was a specific window that allowed for business owners and employers with less than 10 employees to be exclusively dealt with under the targeted part of it. But even right now, like literally, we just got an extension last week from closing yesterday to the end of May. So there's a lot of moving parts in the government right now, and I think they're just trying to fix it.
Right. And I think, you said it best. The real answer is there are a lot of moving parts, and it's kind of hard to gauge, what the timeline of that process is. So definitely thanks for that response. This next question comes in. It's from one of our attendees. They say that they own an accounting firm and they like to do tax planning for their clients. Is it better to take their tax return to manually do a tax plan based on their understanding of the client, or invest in tax planning software to input their data to prepare a tax plan?
That is going to be an effective combination of both, because there's definitely going to be some software doesn't always account for the human element. So
Yes.
that's why you're going to kind of need both. The software part will save you some time in doing some calculations, but that interview, that conversation, understanding those objectives is going to be key in doing effective tax planning for the client, because the objective there is to save money that can be reallocated to other things such as investments, retirements, etc.
Good answer, George. Good answer. We had just a couple more questions that crept in. This question comes to us. I was told that the PPP loan is forgiven if it represents costs related to business need. Is this false information or is it correct?
My understanding is by intention, that's the plan, but it is not automatic. So on the first draw, we knew for sure that there was a provision that it had to be 80% for payroll, then it dropped to 70, then it dropped to 60. My understanding is that on the second PPP loan distribution, while it required more stringent application process, that they still insisted that in order to maximize forgiveness, that 60% of the funds were used for payroll. And the idea here was, you understand, the idea here was to save states some money on the unemployment part by empowering employers to be able to continue to maintain payroll. It still was kind of counterproductive when we had a complete shutdown, So, so that's some of the things you want to consider. But if you still had things such as rent or mortgage payments, et cetera, those expenses are applicable to forgiveness. And I would not be surprised if we consider, or if they consider that block where most of the country was closed, if they reduce that 60% for periods that were during that 24-week period.
Yeah, good answer, George. This next question came in. You talked about 1099Ks, credit cards earlier. Which year will the 1099K need to be reported if credit card sales are more than $600?
That's going to start for 2021. That's effective as part of the American Rescue Plan Act. And it's designed to do a couple of things. Again, kind of get a hold on the gig economy that's running away. And also, these are going to be reported by the settlement companies. So it's not an employer responsibility to report those. The settlement company are going to issue those out.
Okay. And then this last question, I think it's building on a previous question that we had about penalties. It's asking if the partnerships are only penalized if they're formed before 2021.
I'm sorry, say that again. Are the partnerships?
If the partnerships are only penalized if it was formed before 2021. And I think it's building off the missed deadline question.
So if I'm understanding that correctly, let me see if this answers the question. If you formed a partnership on December 30th, you had an obligation to file a tax return and or an extension by March 15th. If it was formed in 2021, then your first reporting date or first filing date would in effect be 2022 for 2021.
Okay. And then our last question for today, George, can you discuss what constitutes gross income on line 7 as a sole proprietor? Now, if you have an invoice to a client but have not received payment as of yet, how do you account for that? Will it go into next year's taxes when you receive the fund? That's a tricky one.
Now, let me make sure I understand the question, because it sounds like the question being asked is whether or not they're doing accrual reporting or cash reporting, and that's what's going to determine when that is done. So, in the cash reporting side to that, it's reported in the year you actually get the income. Okay. So for accruals, though, that part of the accounting spectrum has a lot more planning involved with it when you decide to claim the earnings for the income, because you could very well push it into the next year, or if it's going to benefit you now, you claim it now. But if you don't actually receive it, then you can reduce it in the following year. But there is in this, I think that question was based on a Schedule C or sole proprietor who's probably not going to do accrual reporting. So again, that's one of those things that your specific situation, you're going to want to talk to your tax practitioner, and or sometimes people have a separate bookkeeper from a tax practitioner, and you want to basically do kind of a joint session with them as part of the plan to see which one of those systems will work best for you.
That sounds good, George. I really do appreciate your time and your energy that you shared with us today. The audience has expressed their appreciation as well. And I really thank you again, George, from on behalf of the United States Black Chamber of Commerce. And I want to turn our attention now. We're going to do just kind of a quick sort of a commercial break, if you will. Again, thanking our speaker, George Dandridge, and Elite 8 Tax and Financial Services, who has also agreed to allow us to share this information with you all. So we will be emailing that out to you all in the next 24 hours. And I want to share with you a little bit of information about the U.S. Black Chamber. The resources, of course, that we provide to you are provided by the United States Black Chamber Community Economic Development Corporation. And so today's presentation was a part of the work that we do at the Chamber. We also have some other partnerships that we work on. We're actually partnered with Google. And many of you may know that Google has introduced what's called the Google Black Owned attribute. And this attribute proudly shows, if you're a Black owned business owner, proudly shows that attribute on your profile on Google's Black owned profile page. So definitely go out, if you haven't done so already, set up your business on Google, and then go out and take advantage of that Black owned attribute. We enjoy our partnership with Google. Next thing I want to talk about with Google is the Grow with Google free training. Grow with Google has coaches all throughout the United States that provide different levels of training. And you can find some of these training opportunities on our website by visiting usblackchambers.org/grow with Google. Go out there and check it out, see what they have to offer. And then you're more than welcome to use these resources. They are free, and they're designed to help you and your business, to help your business grow and thrive. The next thing I want to talk about is our buyblack.us platform that we're building at the United States Black Chamber. This is going to be something that's more than a directory. It's a top platform for Black-owned businesses, and it's launching the only Black-owned minority certification. So we're going to be issuing out certifications to verified Black-owned businesses, and we're going to have partnerships with major corporations that do business with Black-owned businesses. So you want to be a part of this platform. There's so many more benefits to this platform than just being found in a directory. There's going to be opportunities to work with major corporations as vendors. So we're looking forward to rolling that out this year. The next thing, you can apply for a PPP loan through Chase. Chase has been one of our partners over the last couple of years. If you're interested in applying for a PPP loan, you can do it through Chase if you have an active Chase business checking account. And if you don't have one already, find out how to open an account and then learn more about chase.com/PPP. And remember, the program has been extended through May 31st, 2021. Also with Chase, we have Advancing Black Entrepreneurs. This is a program where we work together with Chase in their Advancing Black Entrepreneurs initiative. to create 2 modules. Module 1 is on reclaiming the future. Module 2 is on the power of capital. Our next session will be a watch party of the power of capital, which is taking place on April 6th at 2 p.m. Same time as today. So definitely make sure to tune in to that watch party. Also at the U.S. Black Chamber, we offer webinars. This webinar is an example, a perfect example of one that we would preserve and play back for folks to watch as many times as you'd like in order to understand the topic. So definitely go out and visit our webinars and our on-demand resources at usblackchambers.org/webinars. Some of our upcoming events. We have an event that we're partnering with Pharma, America's largest pharmaceutical companies, where we're going to talk about a common topic that is becoming more pronounced in our community, and that is our health is tied to our wealth. So we want you to save the date for April 14th. We're planning to send out invitations and information on this event. You can visit usblackchambers.org in order to stay updated on this event. We also have some pre-recorded events that we like to share. We talked about our webinars, but then we also have some additional events that we've done with Google. One of them is a Black Small Business Meetup. It has been recorded and preserved, and it's available for all of our folks that want to attend and watch and learn more from your peers, from folks that are leading in the industry. All of these folks attend the Black Small Business Meetups. So definitely want to make sure that you have an opportunity to go out and review these pre-recorded events. You can go there by going to g.co /Black SMB Meetup. And then lastly, for all of your updated information and resources on the CARES Act and navigating COVID-19 for small businesses, please visit usblackchambers.org/CARES Act. You can also join the United States Black Chamber by visiting this page, or you can attend weekly webinar series if you'd like. So we really enjoy delivering this type of value to our members, our chambers, and working with folks like George Dandridge. We definitely want to make sure that we continue to deliver these types of programs to you throughout the year and in upcoming years. So I want to make sure that you all have this information handy. Make sure that you think about the United States Black Chamber when you're thinking about advancing your own businesses, and definitely consider joining a local chamber, a local Black chamber, or joining the United States Black Chamber itself. We look forward to having you all. So I want to thank you all for your time again today. George Dandridge, it was a pleasure, sir, and we look forward to doing this again with you next year. Thank you. Thank you all so much, and y'all have a great day.